generally, when you research, you have to understand the business. What is this business? How long it's gonna be a superior business, and does it have legs to run, let's say like that. And if you understand and find that it's a really good business, it has a great long-term potential, then you also have to understand what it will be the substitution and all kind of stuff. As you define, business is good and it has very good long-term potential to grow and be successful. Next step is to go to see within that business industry competition. And if you greatly understand competition, define and analyze competition, and find that you have great durable competitive advantage in one company, I mean, which you analyzing, you have this company that have a great long-term durable competitive advantage, and you believe that will be the case. Then you can go to next step, which is management. Who is running the company? Does those managers have learning skills to run the business, and does this business require very tough and good management or so management? What is the management's contribution? How they can contribute to create great products, services, or good long-term experience. So you have to understand and define and analyze this management. After you complete this section, third step, analyzing management, next one is to go generally analyzing the company ratio and find all kind of things, how everything on fundamental aspects. I mean, and if you find this analysis very helpful, qualitative and quantitative analysis. I mean, when you find this, everything is fine. Company is doing great, and it has very good chance to keep this fundamental factors great for in the short, intermediate or long term. Then it's already very nice and nice further step, which you go to valuing this company. You can use different kind of valuation for different companies. For instance, the company that have only revenue and no profits can be analyzed differently. Depends also for the industry. Some industries are very easy to analyze those. For me, I mean, for different industries are quite difficult. I don't touch industries that I don't understand. I understand. I think quite many industries. So when I analyze this industries and the ratio and everything, I have to be sure that I completely, not completely, but I understand very well what I'm doing and how to value those companies. Can use DCF model if company is profitable and stable and profit. They have, you can use the DCF, or you can use relative valuation if this company does not have very stable profitability. Depends. Very difficult to value some companies exactly as intrinsic value. I try to be very precise, but it's always somewhere in the range where can you define the price, and this is the price. You can use if a company allows, company fundamentals allows you to use both relative valuation, DCF valuation. I use many different also many different valuation methods. And then you can average and find out, define what is the really really truly fundamental value of this company. And if you find a fundamental value, price, value of this company is much higher than the price in the stock market, which this price the stock market gives you, then you can buy and wait. You have to have good emotional control to be able to wait for a long time. Long time. When I analyzing, find out companies generally. I have to have those companies to hold them within 5, 7, 10 years. So maybe more if I check and find out that companies have great fundamentals, nothing changed, company strengthen those fundamentals and everything is going well for the company. Why should I sell it? Why? Because if I sell it, I have to find next great opportunities, and if I can't find such kind of opportunities, then I stick and hold with this company. So I don't like generally selling. I love what I love is find great companies, analyze it as qualitative, quantitative factors, define all kind of these 4 steps which I just mentioned. And if I find this a great company for great long-term investments, you just buy and hold. Why you don't need? For instance, who bought Tesla? It was quite difficult to analyze Tesla. Because it did not have attractive 10 years ago attractive fundamentals, or I don't know, it was just messy and very difficult to analyze, and you had only one good asset, which is the Elon Musk, to invest for him. To invest because of him, and if one bought that 10 years ago, it has nearly 20,000% upside, so profit, very very nice, good performance. And I don't think if you buy and sell and try to sell your winners and find losers, because sometimes low price doesn't mean it's always undervalued. It can be very bad company that's why low price, and it's very difficult. If you see company is doing great, why should you sell to? This is the main points which I look when I analyzing companies. I have great performance. So stick with me, follow me, and I will provide you I don't know, as often as I can, new videos, and it will be quite helpful for you. Thank you and bye.